Hey folks, my name is Luke Burton and I'm excited to welcome everyone to Narwhal's second quarter macro presentation. Now let's get into the content. We're going to kick it off with Ben Nye, our Chief Investment Officer, as he digs into equity markets and some of his thoughts on the economy. Tom Russell, our Director of Fixed Income, will also be joining Ben with commentary on the bond market. And before we start, a very quick disclosure, which you can see on the screen here. This presentation consists of our own research and observations, but it should not be construed as investment advice. If you have questions about your own investments based on the content here tonight, please don't hesitate to contact us directly. And with that, I'm excited to hand things off to Ben Nye for his thoughts on the second quarter of 2020.
Thanks, Luke. So when we were here back in April, we're obviously in a very different time period. We're in a different economic phase. We're in a different financial phase. And what we're going to be looking at today is really the economy and financial markets through the lens of what we see as a significant phase transition. If you think about things like matter, think of ice or water. Ice remains ice for a very, very large range of temperatures, and water remains water for a very large range of temperatures as well. But at 32 degrees, there is a phase transition. And what happens in that transition is that the kinetic energy slows down a little bit, but the potential energy increases a lot. And so that's kind of where we are today. And so when it's 32 degrees outside, 33 degrees, it could snow, rain, sleet, hail, whatever. When it's 50 degrees, it's probably going to rain. And so right now we're closer to that 32 degree mark. And that means that we have a high level of potential energy in the economy and in financial markets, which means that things could look a lot different if things break one way or the other. And so what we want to establish is what phase we are in and what the transition looks like and what phases we're going toward. And so today we're going to be looking at precisely that. What phase is this? What is happening both with the health crisis and the financial crisis? And then what phase is next? And we're especially going to be looking at that through the lens of opportunities. So actual stocks, actual fixed income opportunities that we're seeing in the markets right now, and that we have been acting on and are continuing to look to act on. So let's just get right into it. We're not going to really bury the lead here. We are in the reopen phase. That is the phase that we're in. And from a health standpoint, we can debate the merits of reopening. But from an economic standpoint and factual mobility standpoint, and we'll go into some of the charts here, the United States is still very much in the reopening phase, reopening the economy, reopening hospitals, reopening businesses. But because this is something that very few people with in living memory can remember, we don't really know what it looks like economically. So we're going to explore that question in this section of the presentation. One of the things that really stands out in the first half of the year is the continued outperformance of growth stocks. I think it's a little secret that growth stocks have dramatically outperformed value over the last decade, but it hasn't outperformed by this amount in such a short period of time, really throughout that entire period. In fact, growth in the first half of 2020, based on the S&P 500 growth stocks, outperformed by a whopping 23.5%, which puts really any period in this chart to shame. And so typically people have preferred value stocks because they tend to be more mature companies. They tend to pay higher dividends. They tend to trade at lower multiples of earnings. So people have a perception that they're going to get paid back sooner just because of the earnings power of that company. But they also carry a little bit higher levels of debt and tend to be over-indexed to financial stocks like banks. But in a low growth environment, in a low growth macro environment, in which the Federal Reserve has become highly, highly accommodative with money printing and with low interest rates, what we've seen is that companies burdened by those high debt levels aren't able to grow out from under them. And a lot of people perceive relative safety in actual growth stocks because these are companies that will continue to grow, and the perception is that investors will get paid back eventually. And how much they get paid back is kind of an open-ended question. but it seems like you're taking a little bit of the zero risk, the bankruptcy risk, off the table when you have a high growth business. And so basically what the Federal Reserve has done and what low interest rates have done and what low growth has done is made the return of capital more important than the return on capital. Basically, people are more concerned with companies going bankrupt than being able to borrow for a certain amount and invest for a certain extra return. And so this is a significant change than what we see in normal periods. And it almost seems counterintuitive that growth stocks would be a source of safety in a period like this, but that's indeed what has happened. And I think that's something that's very important to bear in mind, an important context, because we have been in a phase, we have been in a period where growth stocks have been a flight to safety asset. And that continued in the first quarter and the second quarter. Importantly, the US relative to the rest of the world in terms of financial markets continues to perform very, very well. These are the 15 largest economies in the world. Last year, the US ranked second behind Russia. And this time it ranked second in the first half of the year to China. And that really speaks to the diversity of the American economy across manufacturing, technology, healthcare, telecommunications, financials. And it also talks to the statuses of the US dollar as the world's reserve currency. It enables central banks like the Federal Reserve to be the most aggressive central bank in the world in terms of really unloading lots and lots of financial and monetary stimulus into the economy and supporting the economy and the stock market in the face of what was a pretty severe shutdown. And so here's the path that we've had this year. It's all indexed to 100 at the beginning of the year. And what we see is that after a really steep decline, the brown line, which is the S&P 500 in the middle, the green line on the top is the S&P 500 growth index. And you can see that's actually up for the year. And the red line is the S&P 500 value stocks, and those are still significantly down for the year. And again, what we see is that when things bottomed out at the end of March, everything took off. Value stocks took off, growth stocks took off. But since that time, there's been some digestion. Growth stocks have continued to perform well, although they can't make a new high. S&P 500 has performed decently, although it still remains off of its high. But value stocks have really retrenched, and they're about at the levels where they were at the beginning of April. And again, the reason for that is there is some credit risk there. And so the other thing that I want to bring to your attention on this chart is the impressive rebound that we had, and then also the digestion period that we experienced throughout June. And there are some reasons for that, some economic reasons, some mobility reasons that we'll talk about later in the presentation. One of the things that I think is important to point out here is that the VIX level is a measure of, they call it the fear gauge, but basically it's how scared people are of big moves in one direction or the other. Now, typically people tend to be more scared of moves to the downside, but people can also be scared of moves to the upside. And when you see an elevated VIX like this, when the VIX is above 30, like it is, that shows that people are skittish. They are buying, they're aggressively buying protection against extreme moves to the downside or the upside. And what we've seen is that level has come down from the highs in March, but it still remains about double or even triple the levels earlier in this year, which means that, again, we're at this high level of potential energy in financial markets. And that continues to this day. We're going to skip through these slides. We will post the presentation later if you want a little bit more technical look at this. But essentially what we have here is that when this index is high, it means that people are scared of the market going down. And when the index is low, people are a little bit more scared of the market going up. So right now we're a little bit in the middle. So people kind of don't know where the market's going to go. It could go up a lot or it could go down a lot, but they are scared that it's going to move a lot. And what we're seeing too is that there is some more trading in the NASDAQ. than we've historically seen in the past. In fact, there's more trading being done on the NASDAQ versus the S&P 500 than any time in the past, even more than 2000 during the tech bubble. There's some reasons for that. A lot of the companies in the NASDAQ are a little bit more mature than they were in the 2000s. But nevertheless, this shows that a lot of the speculation is happening in the NASDAQ versus your traditional S&P 500 more stable companies. And again, that kind of fits with the move that we've seen in the market with growth dramatically outperforming value. But having said all that, although there is this element of speculation in the market, and I'm sure we've all read the articles about day traders and things like that, the Goldman Sachs risk appetite indicator is actually fairly subdued. It's not extremely bearish. It's not extremely bullish. It was extremely bearish back in March, but that has since moderated quite a bit. But we're also not seeing massive speculation in aggregate. There are certainly pockets of speculation. We talked a little bit about the trading in the NASDAQ and the outperformance of growth stocks. So there are pockets of speculation, but there's also a healthy dose of caution in this market. So anytime this remains below zero, you're going to be a little bit, you're going to have some caution in the market, and that's what we've seen. Similarly, you have seen sentiment improve. This is the San Francisco Federal Reserve Bank. They monitor daily news sentiment, and sentiment's still negative. It's improving, but it's still very negative. And I think that's, again, important to note. It means that there is a lot of concern and caution in the market. And then probably the most important chart is this next one, and that's the Merrill Lynch Bull Bear Indicator. This shows what people are thinking who manage lots and lots of money. So this isn't talking about the retail investor, which some of the other charts did. This is talking about the people who control large pension funds, large mutual funds, large hedge funds, and large insurance companies. And what we see here is that even with the really strong rebound in the market, there's still a very bearish sentiment among a lot of these fund managers. In fact, this suggests a buying opportunity by Merrill Lynch's indicators. And what I really want to point out is this long-only positioning here at the bottom. 95% of the time, long-only fund managers, which is what Narwhal is, long-only fund managers are more bullish 95% of the time. Only 5% of the time are they more scared of things going down. So right now, there's an extreme element of caution, especially among long-only fund managers. And so if you actually think about that, what that means is that if things do start to move to the upside, then those long-only fund managers will underperform, and they'll have to chase to get caught up. And what happens when they chase to get caught up? Well, they put a lot of money into the stock market. And so this is why Merrill Lynch's indicator suggests that this is actually a buying opportunity, even with the strong rally that we've seen. Now, you can't make an investment thesis out of one indicator like this, but that is a sign of bullishness for the market because other people are bearish. Quickly pivot to gold, and then we'll wrap up on the equity section. Gold has obviously performed extremely well this year, and gold is often seen as a hedge against volatility and uncertainty. It's also seen as a value as a store of value in the face of aggressive money printing from central banks. We've seen both this year. We've seen high volatility, and we've seen a lot of aggressive money printing. And so it's not really surprising that we've seen gold be one of the best asset classes so far this year. In fact, gold is almost back to where it was when the U.S. credit got downgraded to AA+ back in 2011. This is about when I started working in this business. Gold just shot up until October 4th, 2011, which I remember vividly as the top in the gold market. But we're almost back there. And today, gold hit $18.40 an ounce, I think. So conclusion for U.S. equities is that we have had a strong rebound from the lows, especially in growth stocks. Sentiment has improved, but it's not excessive, and especially not excessive among fund managers. But the level of fear remains elevated. There's a potential that things could move heavily one direction or the other, and value stocks continue to underperform. And the reason value stocks continue to underperform is because people are scared about companies going bankrupt. And it's a tough environment to invest when you're scared about companies, big companies, Hertz, JCPenney, going bankrupt. And then the ugly is that we do see some pockets of excess speculation, especially in some of these high growth stocks, some of these small cap stocks. And we don't see a corresponding level of protection. So you could really look at it one of two ways. I look at it as a high level of potential energy with and operating in that environment with potential to go a lot up, potential to go quite far down. Shifting gears to a little bit more of the economic fundamentals, earnings estimates have come down 10 to 15% and for 21 and 22. And we're going to be looking through these to kind of get a read on where the economy is from a fundamental standpoint, because as we have talked about in the past, the economy does not equal the stock market, by no means. What we've seen in the most recent quarter is that the dotted line on this chart is the expectation when we last presented it in April. And what we saw is that it is likely, we haven't got the number yet, but it's likely that for the second quarter, the GDP is actually going to be worse than we initially expected. But the rebound is happening more sharply than economists expected. So a sharper decline, sharper rebound, V recovery, but then the taper off. And as we move forward into the transition period, we're really going to explore what that taper off means. And if you look at Q3, we still see a wide disparity in terms of the economic forecasts between 12.5% and 22.6%. Usually this is separated by 0.5% or 1%. Economists are not in agreement in terms of what Q3 is going to look like. And again, that's why the market has a lot of potential energy right now. What we've seen is, in terms of the path, is that initial jobless claims have started to taper off. So they improved rapidly. So we want a low number. We want fewer people getting fired. And so obviously in March and beginning of April, a lot of people were getting fired every week. And still 1 to 1.5 million people are getting fired every week. And that's tapering off. We want that to get down quite low. Before the COVID hit, we were talking more about 220,000 people. We're at 1 to 1.5 million right now, every single week, which means you have to create a lot of jobs to replace those 1 to 1.5 million people. And we have created a lot of jobs, but just not quite enough yet. I mean, we lost 15% of the US labor force in the space of 2 months. That's pretty unprecedented. And although we've increased another 6%, we have a long way to go yet. We still have 15 million net people out of work and who need jobs. And that's going to take quite some time to recover. On the inflation front, we've seen a rebound from that low level in March, when it dipped below 1% in terms of market expectations. That's rebounded in part by the Fed. Similarly, if we look at this chart, we can see a recovery in inflation. But if you look into the end of June and beginning of July, again, we've tapered off in terms of inflation. And if you really think about this, the Fed's target is 2%, not 0.5%. And so what the Fed wants to do is continue to make and continue to flood the economy with money in order to get this inflation number up to 2%. That's going to take some time, especially at the rate that we're going, which is much slower than it was in May and June. Shifting gears a little bit, wanted to touch on home prices. So if we look at employment, things have improved nicely, have tapered off. Inflation, things have improved nicely, tapered off. Home sales have improved and continue to improve quite remarkably. And in fact, home sales is one of the things that is most optimistic about this current economy. What we're seeing is home prices are still up 2 to 3%, even in the context of 15% of the people out of work. And the question is, how is this possible? Well, one ingredient is low supply. So if you think about, you want low supply, high demand in order for prices to go up. because you have a limited good, but a lot of demand for it. Increases prices. Active listings are down 20% on a year-over-year basis. Usually we see more homes sold in this and homes listed at this time of year. We're actually seeing fewer homes. So you can see the lower supply of homes on the market, more than 20% down versus prior year. So low supply. But demand, the actual number of transactions, are actually in line with last year. So if you take 20% of the supply off the market and keep the same number of transactions, you're gonna help support prices. You're also gonna see that home prices and homes are moving faster off the market than they have historically. And what you can see here is that 45% of homes are coming off the market in 2 weeks or less. Only 35% of homes did that last year. So you list a home, it's more likely to move fast than it was last year because there just aren't that many listings out there and the demand is still there. So this is good news for the housing market. It means that we can absorb more capacity and it can support continued rises in home prices, which is good for people who have a mortgage or own a home. So I think, Luke, if you want to jump in on this.
Yeah, just a quick anecdote on kind of the reason houses are moving quickly. We actually do business with a local home builder, and in the last week, he mentioned that apparently a side effect of COVID is people buying houses like crazy. And it sounds like they're moving inventory quickly. Although it's surprising, it makes sense because folks are coming to grips with the reality that they could be spending a lot of time at home. If you've got kids and you were looking to upgrade your living situation in January, come June, you're probably feeling pretty pressured to look at a bigger house.
I think that's exactly what the data is showing. And it's interesting that, when you look at the housing market, I think it's important to look at it both on a micro level and a macro level and see if they corroborate one another. And what we're seeing is that they do. And that the housing market is actually a fairly bright spot in the country right now. Want to touch quickly on the election, and then we'll talk a little bit COVID and then move to the transition period. The general election, I think we've all seen the polls, shows that Trump is losing support and that Biden is gaining on him in the polls and really passing him significantly. But a lot of that is very interesting because it's all Trump losing support and rather than Biden gaining support. These are people who were Trump voters who are not Trump voters anymore. That kind of flies in the face of orthodox election thinking, which is it's the economy, stupid. The orthodox view would be you open the economy, markets go back to highs or close to them, and your poll numbers should go up. But that's not what we saw. And so what we're seeing right now is that even more than the economy, COVID is the critical election issue. And maybe not for the average voter, but for that marginal 10% that decides the election, that's what they care about. And that's what's in the news right now. And so that'll be something important to watch. And it's certainly interesting that voters are thinking about COVID, even more importantly than thinking about the economy. And we can see this even clearer here, where the disapproval rating for the president has almost reached the levels of 2018. In terms of COVID, we can see that, again, no surprises here. Cases continue to rise. Hospitalizations are rising, but not to the level they were. But new deaths is probably the most positive news in terms of it's still staying relatively low. The goal here, the concern is that cases turn into hospitalizations, which turn into deaths. The people who are more optimistic would say that we haven't seen the deaths rise, the hospitalizations are still below the previous high, and therefore we could be more optimistic that maybe we're getting more cases, but we know how to treat it a little bit better, whether we use steroids, whether we use Gilead's remdesivir antiviral, or just general practice in terms of managing this disease. And so that's going to be something that we continue to watch and going to be playing a huge role going forward. And then in the state of Georgia, we're seeing a little bit more excess on current hospitalizations. We're still seeing relatively few deaths, but current hospitalizations continue to stress the capacity of hospitals a little bit. We've talked a little bit about this on the calls, on the daily calls, but we have about 20 to 25,000 hospital beds in the state of Georgia. So we still have capacity, but the concern would be that the current level of hospitalization starts to eat into the capacity of more profitable hospital beds. So things like elective surgeries and things like that. The last thing on COVID is that these increases in cases is turning into tapering in terms of mobility. So mobility had improved quite significantly. The dark blue line is the mobility index in the United States overall. And you can see that that has tapered into June and into July as well. And so the more that this tapers off, and again, this is 50% of previous mobility, the more that this tapers off, the tougher it will be to add jobs and increase inflation and really get the economy back to where it was. So again, the economy is improving, but the improvements are tapering, mobility is tapering, and it will take quite some time to get back to where we were. So if we look at the Phase Scorecard, where are we today? Well, equities are a little bit mixed, but by mixed, I don't mean just kind of could go up a little, go down a little. I mean mixed as in there are real reasons where we could go up massively in the stock market or down massively in the stock market. Earnings and growth are stabilizing out in 21, 22, about 10 to 20% below prior estimates. Employment has recovered nicely initially, but progress has slowed here in end of June and into July. Same thing for inflation. And that's really kind of tied to that COVID case rise, the mobility taper, which is incidentally hurting the election chances. But again, housing is the bright spot in this economy. We still have moderate demand and we have pretty low supply, which is really helping to support prices. So that's where we stand today. But the question is, where are we going? And so that's what we want to look at next.
So yeah, as we enter the discussion on the transition phase, I think this quote by Marie Curie is perfectly relevant. She's got 2 more Nobel Prizes than I do, so I'm going to trust her word on the nature of progress. But the truth is we're staring down the barrel of a long recovery process. And at the heart of everything, the Fed is doing everything in their power to speed that process up. And going back to the analogy of water going through different phases, if our economy is an ice cube right now, the Fed is trying to melt it down with a leaf blower. So Ben's going to move into this discussion of the transition phase and talk a little bit about the trends that we're seeing as that ice cube starts to melt down.
Awesome. Thanks, Luke. So again, we're seeing that taper. So that's kind of where we are right now. And then if we translate that into the jobs market, we showed this chart earlier, the blue line, but the red line shows the continuing claims. So this aggregates all these initial jobless claims and says how many people are filing for unemployment each week in aggregate, not just people who were laid off last week, but people who continue to file. And we see that is having a nice downward trajectory, but because of the elevated levels, it would take about 8 months to get back to the levels before COVID, which would put us at about March or April of next year. But again, the problem is we're starting to see the progress taper. So even if we continue on this downward trajectory, it's going to take 8 months. The concern is we're not going to continue at that steep of a pace. So that's where we stand on the jobs front. In terms of retail spending, what we see is that similar to mobility, travel and entertainment down 50%. Which makes sense if mobility is down 50%, but that has severe implications for a lot of companies. Total spending has improved nicely. It was down over 50%. Now it's leveled off, but again, it's leveled off at lower levels. The one area doing very well is retail when your card is not present. So That's your e-commerce. That's your Amazons of the world. That's up 50%. The other thing in terms of mortgage and auto applications performing well. You could argue there's a little bit of a taper off there, but housing continues to pick up. It was down over 60%. Now it's up. So people are really trying to get those mortgage applications and still trying to get auto applications as well, auto loan applications. So people are willing to spend on big stuff, but right now retail spending is still down quite significantly. And we can see that again here. If we look at the chart of weekly economic indexes put out by the New York Fed, you can see that we're still down 6.8%. And if you put this in context, 6.8% makes 2008 looks like child's play. So this recession is deep, and it's going to take some time to get out of that.
Yeah, I think it's important to stop here and just reiterate one of our favorite talking points at Narwhal, and that is that the stock market is not the economy. Just like Ben said earlier, we were looking at a slide of the S&P 500 recovery, and taken alone, it doesn't look half bad when you compare it to 2008. But here, looking at the weekly economic index, especially from 2008 to the present day, we see a pretty sharp reminder of the depth of this economic slowdown. And it makes 2008 look tame. So I just think this is a solid example of how economic data and market data often will tell two very different stories.
If we continue, see that manufacturing has improved, but again, from low levels. This is all relative to the prior month. What's interesting here is the red line's China, green line's Europe, blue line is the United States. Because of the scale of the shutdowns in the United States, and because of the fiscal and monetary stimulus, we did not dip nearly as much as China or Europe. And the same can be true for the services index. Again, we did not drop nearly as much as Europe or China in this. And part of that, again, is due to the severity of the lockdown. Europe locked down more strongly and ubiquitously than the United States did. You can argue the costs and benefits of that, but these are the facts. And we had a little bit less, we had significantly less of a dip than Europe. But again, progress continues to be slow because of that taper off in mobility and pickup in COVID cases. On the positive front, the economic surprise index is at an all-time high. But what ends up happening with economic surprises is because then the economists raise their estimate and you can't jump over that hurdle. Furthermore, we're starting to see economic data show less progress from week to week and month to month, which means that this number is likely to come down. Robert Oppenheimer once said, the optimist thinks this is the best of all worlds. The pessimist fears that this is true. And that's what this chart basically says. This is great. We're beating expectations by a lot, but there's really only one way to go in terms of surprising the market. Moving on to the Fed, we've talked a lot about the money printing on this call already, but I think the big thing to note here, and Tom's going to jump in a little bit, is the scale. We printed about $3 trillion. We've added $3 trillion to the Fed's balance sheet, which is triple the amount we added in 2008. And we've cut interest rates by 150 basis points to effectively zero.
Yeah, jumping in here, Ben, on the Fed, Jay Powell has been very candid about the fact that they learned a lot in 2008 and they were super quick to act and severe to act this year. We basically saw a full meltdown of the bond markets in the middle of March, and there was zero liquidity. And so the Fed stepped in essentially to restore the capital markets and prevent a financial meltdown a la 2008. And so what that means is there were basically only sellers in the bond market. We were seeing prices fall precipitously at levels we'd never seen before. The Fed stepped in. They started buying treasuries. They started buying mortgage backs. They started buying munis, ETFs, corporates. They basically filled in and made it possible for the secondary market to continue to have normal bond trading, as well as they allowed companies that were looking like they may fail to enter the capital markets. And as a result, we saw record issuance in corporate debt. They brought the rates down. Corporations were able to fill their balance sheets with cash by levering up and issuing bond debt. And really, the severity in which they moved prevented a big pullback, especially on the bond market.
You can see this in the next chart as well. The Fed's balance sheet is now 33% of GDP. That's going to go higher because the Fed's going to keep printing for a while. And you're also going to see GDP go down. So that's probably going to move to 40% or even higher over time. But what it did was, this is a measure of financial distress. When it's high, that means that the markets are very distressed. When it's low, it means there's not that much distress in the market. That was 2008. 2008 was severe, but because the Fed acted so rapidly and so aggressively, 2020 has not been nearly as severe as 2008. On the fiscal side, the U.S. Treasury has rarely carried that much of a balance. They started to carry a little bit more of a balance after 2008, and they really started to increase the balance when the threat of government shutdowns was coming, because they needed to have that cash. They needed to be able to issue new bonds. But right now, what we see is an unprecedented level of cash just sitting around at the U.S. Treasury. Now, the U.S. Treasury isn't just sitting on $1.6 trillion of cash to just sit on it. They're going to spend that at some point. And that's a ton of spending power, especially if you leverage it with the Federal Reserve. And that is likely to flow through to the economy, whether that's new congressional budget action or what have you. But this is the purse that Mnuchin has to work with right now. He has more money than Bezos, which not a lot of people can say. And what this is doing is, it means that the federal budget deficit is going to unprecedented levels as well. Federal budget deficit is now 13.8%. That's about to go bigger as well, because GDP is going to go down and we're going to continue to spend a lot of money. So if you call it 20%, this means that net government spending in excess of taxes is 1/5 of the U.S. economy. And that's the world that we're increasingly living in. That's the world that we're transitioning toward. But what this is doing, what this fiscal spending is doing, what this monetary spending is doing, is it is supporting the consumer. It's providing $600 extra in unemployment checks and a lot of stimulus to severely hurt businesses. And that is supporting retail sales. So retail sales in aggregate are almost back to where they were in the levels right before COVID. And this would not happen if we had lost 10-15% of the workforce and they didn't have any extra money. So we're seeing a significant rebound in retail sales. Now, is it going to go much higher than this? Probably not. But we have seen a pretty strong rebound so far. And it's really driven by the rapid growth in e-commerce. So non-store retailers, companies without a store, basically companies that only operate online. And that growth has performed extremely well in this period where people can't shop. So it kind of makes intuitive sense, but it's interesting to see actually these companies visibly take market share from legacy established brick and mortar retail.
I think there's kind of two things at play here. I can relate to both of them from the last couple of months. The first is just the safety incentive to shop online rather than braving the aisles. And the second kind of goes back to the home sales data. And I frankly just think people have more time to window shop. They're stuck at home, they're on their computer, and it's easy to browse Zillow and to browse Amazon. What's interesting here is that dip in June. I think that can probably be attributed to that 2 or 3 week period in the middle of the summer where things started to lighten up. The news cycle started to move a little bit away from COVID, and folks started coming out of their homes and going out into the world again. And clearly things have returned back to pre-June levels, but it's interesting seeing that dip.
But no, you're exactly right, Luke. I think you're spot on with that. And so the question is, well, when does this normalize? I think listening to what actual business leaders who actually have to manage a business here this is important to do. And Jamie Dimon, the CEO of JP Morgan, who's not one who's short on confidence, says we simply don't know. And it says We're prepared for the worst case, but we simply don't know, and I don't think anyone knows. Similarly, Mike Corbat, who tends to be a little bit more conservative, he's the CEO of Citigroup. He says that to him, it doesn't seem likely that the economy will loosen until vaccines are widely available. And we'll talk a little bit of vaccines here coming up. But it's unlikely that that's going to happen until probably the middle of next year. So a fairly dour forecast from both of the bank CEOs, but fairly realistic forecast as well. Because if you think about you and your family and going to a football game and not being concerned and not feeling like you have to go get tested or not feeling like you have to wear a mask or take 3 liters of hand sanitizer into the stadium, I think that's a little bit ways off. And in terms of politics, where are we transitioning? Well, right now it's basically a coin flip. These are the prediction markets that say Vice President Biden has about a 62% chance of becoming elected, and President Trump has about a 40% chance of winning a second term. I think right now, call it 50-50, because, for those of you who can remember back to 2008, July was before the vice presidential pick. It was before the economy really collapsed. It was before Lehman Brothers. And so things changed dramatically in the 3 months before the election. Similarly, 2012, unemployment dropped precipitously ahead of the election, really supporting President Obama's reelection bid. And then 2016, we didn't know the likelihood of the election until the night before. And then even the week before, there was the FBI investigation of Secretary Clinton. So, anything other than a coin flip right now, I think we just have to wait and see. And then in terms of the COVID vaccine, we've had a lot of news on this. The leaders right now in the clubhouse are AstraZeneca, Moderna, Pfizer, and Johnson & Johnson. One of our new guys, actually, who Luke will introduce at the end of the call here, recently did a deep dive into all the trials that have been going on. And he said that Pfizer is probably in the lead, followed by AstraZeneca, then Moderna, then Johnson & Johnson. AstraZeneca and Johnson & Johnson are more traditional. Moderna and Pfizer use this new mRNA technology, which is somewhat unproven, but does have a decent amount of potential. But I would say that AstraZeneca and Johnson & Johnson probably are betting on history, and then Moderna and Pfizer really trying to innovate with a new vaccine technology.
So a hypothetical question for you, Ben. If a legitimate vaccine is announced before in November, how do you think that impacts Trump's campaign? Is that the push he needs, or has the damage already been done?
I think a lot of the damage has already been done. I think a vaccine would certainly bolster his support within his own party. I think it could also be looked at as convenient for people on the other side. What it does to that crucial 5 to 10%, I really don't know. I would imagine it probably helps at the margin. But right now, I think probably what the best potential scenario for the president has, and I'm not saying it's likely or unlikely, but that's for those deaths to remain quite low, for hospitalizations to remain low, and for cases to ultimately plateau and start to decline ahead of the election. I think that's probably the best support for his re-election bid. I think the vaccine, it could go either way, and especially if AstraZeneca gets it, that's not a U.S. company. And so I think that also, it's difficult to say that, he led the innovation push if it's a UK company that ultimately delivers the vaccine. It's a good question. So as far as the economic outlook, I think it's worth summarizing in this FOMC projection. This is the Fed, the guys who are printing the money. I think it's as good a gauge as any as to what the consensus is for the path of GDP going forward. And that is, we see a sharp drop in 2020, followed by a good rebound in 2021. But again, we're not getting back to normal until 2022. And you can see that in terms of the unemployment rate as well. I think what's important to remember in context of all of this is that the federal funds rate, the base interest rate, is effectively zero for as far as the eye can see. Beyond 2022, it could still be zero. They say longer run, but longer run might be 2030. we don't really have a path forward to 2.5%. I don't think they do either. In terms of economists, we showed this chart earlier, but again, big rebound here in Q3, followed by improvements throughout. But again, we're starting from such a low base, it's going to take a while for us to get back to where we were. So overall, the transition scorecard, right now we're seeing GDP growth of roughly 5 to 7% for 2020 in total, up 4 to 6% in 2021. If we do get a vaccine that's effective and can be distributed rapidly, we could see better growth in 2021. Unemployment likely to improve modestly over the next couple of years. Politics is going to be a coin flip. But again, we talked about we have a high degree of potential energy in both the economy and financial markets as well. We're getting a lot of vaccine phase 3 milestones in September to November. And that could really dictate what ends up happening, both for stock markets and for the economy over the next 6 to 12 months. But kind of don't want to end it there. I told you I was going to give you some fixed income and some stocks that we've been looking at and purchasing that fit our worldview right now, and also have durability for the years to come. And so we want to continue to look for opportunities, because we do think that right now there is a lot of opportunity in this market in a number of areas. So Tom's going to lead it off on the fixed income side.
So the biggest macro trend we've seen really over the last couple of years, but it's been very blatant this year, is the rise of the bond ETF and passive investment in bonds. It used to be 4 or 5 years ago, a lion's share of the percentage of ownership in bonds, individual bonds specifically, was, your little old ladies who had bond portfolios. You'd have your grandma pass away and find out she had millions of dollars in a bond ladder. We've really moved away from that, and a lot of that is due to spread compression and fee compression on the bond side. And the lion's share of what used to be dominated by individuals, banks, and insurance companies is quickly being encroached upon by ETFs and mutual funds. And as we'll get into the nitty gritty of how we buy bonds, we'll see that affects the way we buy bonds and actually creates opportunities for us. Additionally, since the last tax changes in 2017, we've seen just an absolute vacuum of supply of tax-exempt municipal bonds. And from year to year, most of the new issues on tax-exempt munis comes from refunding, which is to say, Cobb County issues a bond in 1985 when rates are much higher. They're paying 6-7% on that debt. They can get a better rate now by refinancing. So they would pre-refund a bond, and they could do that at any time and basically say, hey, we're going to issue a same size bond at 3%, pay off the old one, and refinance our debt. Well, in 2017, that went away. Now you can only pre-refund a bond within 90 days of its maturity or a potential call date. And so that has really, really dried up the availability of tax-exempt bonds. And what that's given rise to is a humongous growth in taxable municipal bonds, which are bonds that are essentially identical to tax-free bonds, but the difference is you don't get that state and federal tax exemption. So what the loopholes were created on that were you could refund tax-exempt munis with taxable munis. You may not get the lowest rate available, but because you don't have to meet so many criteria to get that tax-exempt status, you can refund your debt at a lower level, but the people buying it are not going to get that tax-exempt status. And essentially that was a workaround for the government to say, hey, we're cutting taxes, but we're going to eliminate a lot of opportunity for people to avoid taxes. So when it comes to buying fixed income, it's a pretty difficult environment right now. And when we think of buying fixed income, we look at it almost like the lens of buying a diamond. When people talk about buying engagement rings, you're talking about cut, clarity, carat, and color. And so if you want a really big diamond, and in this case, a high yield bond, you're probably going to have to give up on quality, right? Because there aren't humongous, super clear, clean, well-cut diamonds for a cheap price. And so you have to manage those different pieces. And that's how we approach the bond market. So first is price. You really make the money on bonds when you buy them. You lock into your yield to worst or your yield to maturity based on the price you pay and the cash flows available to you. So we talked about earlier, there's been a huge encroachment on the ownership of bonds by large ETFs and mutual funds over the last few years. And what that creates is an anomaly we call odd lot theory, which is essentially the bonds we're buying to make up your portfolio of 10, 15, 20 bonds stacked up, to create a $500,000 portfolio, those are really not interesting to mutual funds or ETFs. They've got huge inflows. They've got to put money to work. And so they're buying millions of bonds at a time. And as a result, these little onesie, twosie pieces that fall off the pile trade, even though they're identical bonds at smaller increments, they trade much cheaper. And so you may be able to pick up incremental yield across an entire bond portfolio by picking these individual bonds that are just being left by the wayside by big funds. Oh, we skipped over it. So the second would be credit. So managing credit right now is also extremely difficult. With the Fed stepping in and buying investment grade corporates, that sucked a lot of the value out of the corporate market. And with high demand for taxable munis and high demand for tax exempt munis, we're really having to look for opportunities in credit. And right now, the largest area of the bond market is triple B corporate bonds. And so there's a lot of oversight there. There's a lot of action there. There's a lot of demand there. So where we're looking is for what we would call story bonds, which are essentially bonds that maybe smaller companies or maybe companies that aren't as big a name, they may be overlooked by the credit agency. So they may be rated triple B, but they've done a lot of legwork in the last few years to clean up their balance sheets, and they have not been re-rated. However, they are trading like a high yield bond would. And so we go out and we look for these different story bonds to, like the odd lot theory, we're looking for these bonds that people aren't looking for. We're picking them up a little bit cheaper because we've done the legwork and we know that the credit story may actually be a lot better than the rating agencies are willing to admit, and we can pick up incremental yield there. The third piece would be structure. The most high demand bonds are the ones with the most certainty of structure, which is to say, how much you're getting paid and for how long. So we're out there looking for opportunities in areas that are not like that. We're looking for floating rate bonds where potentially the coupon could fluctuate based on an index. We're looking for sinking bonds, which are bonds that have an undefined maturity, which is to say that pieces of the bond will slowly come off at par over the period of time we're holding it rather than all at once, like a typical bond. And you can find opportunities there because people aren't looking at sinking rate bonds because the duration or the holding period of your bond is not certain. And then the third would be convertible bonds. And those have been in the headlines a lot lately because things like the airlines have been issuing a lot of convertible bonds. And they are pegged to the common stock associated with the bond. So say Delta stock has gotten really beaten up this year, but they need to raise debt. They can issue a bond that is tied to their common stock. So when the stock price rises, so do the value of the bonds. And eventually you can convert those bonds into equity at a nice gain. And so we're looking in the convertible space as well, because you don't have that defined maturity, because you don't have a defined holding period or coupon, you don't have certainty that the price is going to rise on those bonds and on the equity associated with it. We can find externalities and opportunities in that space. Next would be maturity. When it comes to buying bonds, you want to have continuous return of capital. So you want to have short bonds, medium bonds, and long bonds. And there are different opportunities in each space. Right now, on the short end, we think that agencies are probably the best bet. You're getting essentially a government-backed bond inside of 2 or 3 years, and you might get 3 or 4 times what a treasury would pay, while you're still maintaining a government-rated AAA rating. In the medium horizon, that's really where the story bonds come in. You're taking a little bit of credit risk, but you're not taking a lot of duration risk, which is to say, this may have a little bit of hair on it, this bond, but we are certain that XYZ company is going to pay off their debt inside of 3 to 5 years. We wouldn't want to take that risk on 15 to 20 years. And then on the long end, that's where we're starting to see some demand for, or less demand for, taxable and tax-exempt munis. And opposite to the story bonds, those are going to be much cleaner. They're going to have much more certain cash flows based on essential service revenues like water, sewer, bills, and general obligation, which is ad valorem taxes, your housing taxes, your car taxes, all those pay general obligation bonds. So if we're going to go out on the long end, we're going to want to have the certainty of repayment. And so that's where the opportunities are on each peg of the maturity scale. And then finally, we're looking at different sectors, even within corporates, within taxable munis, within regular munis. And right now, because the Fed has stepped in and started buying triple B corporates, they're at all-time historically poor values. Right now, you're looking at under 2% on a 10-year bond in corporates, which is really, really not what you want to be paying. When I first started trading bonds, you want to get between 300 and 500 basis points over a comparable treasury. Right now, you're getting less than 100. And so you're not really being compensated for your risk. So those are sectors we're avoiding. There are some sectors that appear to be more advantageous than others, like financial bonds right now, from a valuation standpoint, look very cheap. But the problem is they're also the ones that you probably don't want to have that much exposure to. And so as a oversight, or as an overarching theme right now, corporate bonds that we're not doing just a ton of legwork on and know the story in and out, we're just avoiding altogether.
Thanks, Tom. Good stuff on the fixed income. In equity markets, we're seeing a similar story. We have a lot of indexation, a lot of flows into passive funds. And what this means is that there's opportunity on the active side. So the black line is the flows into active, or really what has been flows out of active. And the blue line is the flows into passive. And what we see here in just about the last month is that there's actually been increasingly flows into active funds, and that's because that's where the opportunity lies. And so in markets like these where dislocations happen, that actually create some opportunity on the active side, where if you are discerning and can identify value, and you can identify good companies from the companies that are filing Chapter 11, that's where you can really create value. And what we've seen is active managers have actually had a relatively strong first half of the year. Most are still underperforming, but cut some slack. So 42% beat in the second quarter, but it's still the best quarter for active U.S. equity markets since the first half of 2017. And again, we can see in this chart, and we shared this chart at the end of the first quarter, and that is when in periods of high volatility, so you think 2000 area, 2008 area, that's when active managers mutual fund managers have outperformed the respective benchmark. So what we're seeing on the active side is three companies that have all been pitched actually by various people on the investment team here over the last 3 months. One is ServiceNow. ServiceNow basically automates workflows within large corporations. So think of onboarding a new employee. You got to find them a desk. You got to get them a phone. And think of all the processes that then take place. Well, if they get a phone, the purchasing department has to sign off on that and actually get it done. You have to communicate with fulfillment. They have to have a secure phone. So IT has to be responsible. Their boss has to know about it. So all these different people have to sign off on it and actually get it done, just so that person can have a phone that's approved by the company. And that's what ServiceNow does. It basically automates that. And what they've done is that they've turned the corner on cash flow. They're net cash generative, and that is growing significantly. And so we think the market underappreciates that growth and the stickiness of that business. L3 Harris is a merger that actually happened last year between L3 Technologies and Harris Corporation. Both were kind of mid-tier, mid-large tier defense subcontractors and contractors, but together they can now bid on larger contracts. So they have some significant revenue synergies. There are definite benefits to being one of the larger players who can lobby and play in large government contracts. And that's what L3 Harris can do now. On top of that, they're consolidating a lot of the businesses. L3 had many, 80 different reporting divisions, and they're consolidating that down. And we think that that's going to result in nice cash flow and good earnings growth going forward. And then the final one is one we've all heard about, and that's Visa. I think people underappreciate that this was pitched by one of our new analysts, Vincent, and he noted that people underappreciate the difficulty to replicate this business. So they're about twice the size of MasterCard. They trade at a little bit cheaper valuation, and both Visa and MasterCard were actually started by a conglomerate of banks. And so to start something from the ground up to compete against these two really makes it difficult to compete. And so what we have is basically an oligopoly, and we expect that Visa and MasterCard will be with us for many years to come and should have good earnings growth going forward. So the big conclusions that we want you guys to take away is that the economy has really improved nicely from the lows. Nice V-shaped recovery, but the progress going forward is going to be a little bit slower. Might be significantly slower than May and June. And it might take a long time to get back to where we were. On the equity side, the equities are not the economy. And, because although sentiment is elevated, it's not too high, especially among fund managers. And because we have this big ball of potential energy, we could really break out big one way or recouple with the economy on the other way. Federal Reserve and a lot of fiscal stimulus are key variables, and obviously the vaccine is a key variable as well. And on the fixed income side, although yields are low, there's still opportunities for outsized returns by being diligent and just scanning through large numbers of bonds and finding the ones where the value is. And then in terms of the virus, that's going to really feed through those top three, the fixed income, the equities, and the economy. But we agree with Mike Corbett, and we do think that we're likely to need a vaccine in order to be fully, quote unquote, back to normal. AstraZeneca probably, or Pfizer, has one of the best near-term candidates, but we should be getting a lot more news in the September-November timeframe on all of this, and that'll inform us going forward. So plan for another eventful quarter. The economy should improve slowly, or at least at a slower pace than it did in May and June. And equities, it's going to be dependent. It's going to be a dependent variable from a lot of these other factors. So with that, I'm going to hand it back to Luke, who's going to introduce what some of the updates are at Narwhal and some of our new employees, and then we'll close for questions.
Thanks, Ben, and thank you, Tom, as well. That was fantastic, guys. Lots of information there. And again, this will be up on our website if you want to go back through and either check out the slides, read through them at your own pace, or watch any of this over again. I do want to go through a couple of announcements here. Ben, if you'll go to the next slide for us. Perfect. So we are super excited to have added 3 new employees this summer. And I know a lot of businesses have struggled with disruptions from COVID, and we have as well, but this is definitely a bright spot in our year. These guys are fantastic. Vincent Chow comes to us from Emory, and he's already started working on assisting our investment team. So every stock that we buy for clients has in-house research behind it. And that's Vincent's job. Is he digs in on these companies and presents to the investment committee. He does absolutely fantastic work. Jason Sieb is a recent graduate of Vanderbilt, and he's kind of our jack of all trades. So when we have new ideas, even if they're off the wall, it could be the vaccine research. Jason's the guy that digs in, and he does the due diligence for us. And then last but not least is John Grayson. So John Grayson is actually a former intern of ours. He is a newly minted MBA from Auburn University, and he is joining our client services team. So he'll be helping out on internal operations and on the 401k side of our business. So these guys joined just a few weeks ago, but already they boosted our capacity immensely. And I'm really excited to introduce them to clients and friends as well. So this is the end of our presentation. I do actually have a couple of questions. The first was directed towards me. I feel honored. And going back to the leaf blower and ice analogy, the question was, what brand of leaf blower do you prefer? Well, I'll be honest, I have no brand loyalties when it comes to leaf blowers. I just want one that's louder than my neighbor's so I can wake him up earlier than he wakes me up on the weekends. The second question I have is, I'm actually going to throw this to both Ben and Tom and get their takes on it. And this is it. Assume a Biden win in November. What should we do in the short term? Should we move into more cash, assume a pullback, stay in equities? What's the move with a Biden win? Ben, we'll start with you.
So on the equity side, I think that so asset allocations are strategic. That should be a personal decision. Asset allocations are determined by your risk tolerance and your return objectives. And so the reason you have those return objectives and that risk tolerance is so that you can be comfortable with a range of potential scenarios. I think that trading politics can be dangerous at times. I mean, I think we all have our respective political views, but trading politics can be tough. I think that However, there's a different discussion when you talk about your strategic asset allocation, and then you talk about your allocations within that respective allocation. So, for example, on equities, one of the strategies would be, okay, well, you might want to reduce some of the defense exposure in the model. You might want to stay away, and we talked a little bit about this, if corporate tax rates are going to increase, you might want to reduce some of your exposure to companies that do pay the corporate tax rate. A lot of companies don't pay the corporate tax rate, but a lot of companies, especially retailers, et cetera, they'll pay that corporate tax rate. But there'll also be companies that benefit under such an administration, especially companies that are allocated to perhaps clean energy, things like that. So there are a range of potential scenarios within that. I don't think we know enough about the Biden proposals yet to really have a firm, I can't give you a firm answer one way or the other, but it's definitely something that informs our thinking. But certainly from an asset allocation, I would not take drastic steps based on who holds the top political office.
Yeah, I'd absolutely agree with Ben. I mean, it's all top down. It begins with asset allocation. As it relates to fixed income, I think you hit the nail on the head as well with, the tax rates are going to be really a focal point. So if you're buying tax-exempt munis, which we do for a lot of clients, and it's really the lion's share of our fixed income, those are going to be even harder to come across. If tax rates go up for corporations, the corporations are going to be buying munis. Banks are probably going to ramp that back up again, and individuals with high income are going to ramp that back up again. And we're at historic lows on yields on munis, and I expect that to continue. On the flip side, I think taxable munis would present even better value. When Biden was vice president, we had a lot of taxable muni issuance back in 08, 09, and 2010 as part of the Build America program was funded almost entirely by taxable munis. And we haven't had that level of issuance since then. And I think that if we have a similar rollout in order to continue to stimulate the economy, I think that we'll probably see something along the lines of the BABS program rollout in taxable munis, which could, increase supply there, give us better opportunities to combat against the high-priced corporates.
Tom, I'm going to actually jump straight back to you. We got one more question, and this is fixed income related. I think you'll like this one. This is one of your favorite questions to ramble about. Excuse me. What is the size of the non-mutual fund purchased bond universe? Are opportunities abundant, or is it difficult to find good buys?
Well, right now it's very difficult. I mean, demand is so high that even on odd lots, there's a lot of demand. But the thing is, there are hundreds and hundreds of thousands of bonds traded a day. And, it's super time consuming, but our job is to go out and find them. Ideally for our clients, again, based on how big your account is, it's harder to fill a bond portfolio for someone who's got $5 million versus $100,000. But I mean, anything over $100,000 for someone's bond portfolio, we can very comfortably build a bulletproof bond portfolio made up of muni and taxable munis and corporates and preferreds and closed ends at reasonable values in really any rate environment. The hardest part is looking for them. It's super time consuming. We're working on coaching up Jason, who does some of our special projects research, to be more aware of how to find and identify, what we would call cheap bonds. But it's a process. It's just super time consuming, but we can do it.
Awesome. Well, thank you again, Tom and Ben, and everyone that joined. We appreciate your time and spending an hour with us on a Tuesday evening. Everyone stay safe, and we will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.